Hello everyone, my name is Lily Chilton. I am an enrolled agent, certified acceptance agent, electronic return originator, and e-file provider. Today's topic is about the new and updated tax provisions for individual and businesses in relation to COVID-19. So at the end of this webcast, if you have any questions or information that you need clarifications or verification, please do not hesitate to contact me. My telephone number is 310-800-1932 and my email address is lily@cpa-consultants.com. So let's begin. Let's start on the tax provisions for individual tax filers. In summary, we have educational assistance, charitable contributions, medical expenses, economic impact payments. We have a few more: retirement plans, distributions, recontributions, and loans, required minimum distributions or the RMD rules, and the repeal of maximum age for traditional IRA contributions. These are the topics that we are going to discuss for today. Okay, so let's begin with the educational assistance. Okay, for educational assistance, effective for payments made after March 27, 2020 and before January 1, 2021, employers can pay the principal or interest of an employee qualified education loan and exclude the benefit from the employee's taxable income. Okay, the prior law to this is employers can provide up to 5,250 of educational assistance to an employee to help pay for tuition, books, and supplies and exclude the benefit from the employee's taxable income. So it's excludable. This is excludable as well. The only difference is that if the educational assistance is if the benefits exceed 5,250, the prior law there's a limitation of 5,250. The cost of education may still be excludable. So that's one of the big factors of this change. The limitation was taken. Okay, so let's go to the charitable contribution. Let's see. Effective for 2020, up to 300 of qualified charitable contributions are deductible as above the line. So in tax filing, there's above the line and below the line. Above the line deductions in calculating AGI without the taxpayer having to itemize deductions. For taxpayers who itemize the 60% of AGI limitation of cash contributions, and it is increased to 100%. So before the prior law, taxpayers must itemize first to claim the charitable contribution. Now you don't have to itemize. Even if you file using the standard deduction, you can still take this $300 qualified charitable contribution. So you don't have to itemize. You don't have to break the 12,400 or however much it is now standard deduction. Okay, so before you have to itemize, and only 60% of your cash contribution is allowed. Now you don't if you are itemizing, you can take 100% of your cash contributions. I would like to remind though that this is only applicable to your cash contributions. Okay, cash contributions to public charities are generally limited to 60%, as mentioned on here, um, um, of your AGI. Non-cash contributions are limited to 50% of AGI, and a 30% AGI limitation applies for donations to certain non-AGI limit organizations and capital gain property to AGI limit organizations. So that is a more detailed, it's a deep dive conversation, but for this for the purpose of the new tax provisions, this is about the cash contributions only. So you get an automatic $300 of your qualified charitable contributions, up to $300, even if you file using standard deductions. You don't have the requirement to itemize anymore. Okay, now for medical expenses. So before, from the prior law, only prescription drugs. So the prior law is medicine and drugs are treated as medical expenses deductible as itemized deductions only. If the medicine or drug is prescribed drug or insulin, you have to have a prescription for it. So if you bought something from the pharmacy and there's no prescription for it, like the over-the-counter medicine, if it's generic and you don't have a prescription for it, it does not apply. So now, slightly, let me see. Now, as you can see on here, over-the-counter medicines and drugs include amounts paid for menstrual care products such as tampons, pads, liners, cups, sponges, or similar products used by individuals with respect to menstruation or other genital tract secretions. So now the limitation was lifted. It does not apply anymore to only prescriptions and insulin. What do you call this? Insulin expenses. Okay, so that's the big news about that. Now, the economic impact payments. Okay, so as you can see, most likely most of you have received the 1,200 plus the $500 for each qualifying child as a refundable tax credit on the 2020 tax return. If you haven't received it yet, then it's refundable tax credit. But if you received it, then it's a reconciliation that needs to get done on your tax return. So the previous law was the Economic Stimulus Act of 2008. Remember when we had the recession in 2008? Provided taxpayers with an economic stimulus payment of up to $600 only, and 1,200 for marrying filing joint, plus only $300 for each qualifying child. You see, before it was only $600 if you're married filing single, or if you're individual, and 1,200 if you're married filing joint, and only $300. So this is the main difference to that. And of course, there's the threshold limitations were also updated on here, the brackets. Okay, so a refundable recovery rebate credit was allowed on the 2008 tax return for taxpayers who did not receive an economic stimulus payment. So if you did not receive it, it will be a refundable tax credits. Okay, so let's go to the retirement plan distributions, contributions, and loans. Let me see. the case of coronavirus-related distribution made on or after January 1, 2020 and before December 31, 2020, the following provisions apply. Distributions from the plan are included in taxable income ratably over 3 years, beginning with the year of distribution. The prior law is distributions from the plan are included in taxable income within the year with the year of distribution, not over 3 years. Okay, so this is a new rule. Now you can what do you call this, rate it out for 3 year period. Okay, and the 10% early withdrawal penalty does not apply for 2020. The prior law is there's a 10% early withdrawal penalty if you take out your money before you're 59 and a half years old. Okay, the taxpayers may recontribute any portion of the distribution during the 3 year period beginning the day after the date on which the distribution was received and treat it as a tax-free rollover. The prior law is you only have up to 60 days. Okay, you only have up to 60 days beginning the day after the date on which the distribution was received to make it tax-free rollover. Now you have 3 years to roll it over to a qualified retirement plan. Maximum loan amounts are increased and repayment due dates are delayed 1 year. Okay, plan loan relief due to COVID-19. If a taxpayer has a plan loan repayment due from March 27, 2020 to December 31, 2020, the due date may be delayed for up to 1 year. Okay, it may be delayed for up to 1 year. Also, for plan loans made from March 27, 2020 to September 22, 2020, the limit may be increased to the lesser of $100,000 or the taxpayer's vested benefit under the plan. Okay. Alright, so that is the retirement plan. Now let's go to the next portion. Required minimum distribution. Okay, let's see. Under the CARES Act, no minimum distribution is required for calendar year 2020 from an IRA or from an employer-provided qualified retirement plan that is a defined contribution plan. The next RMD will be for calendar year 2020. This provision waives the 2020 RMD rules for lifetime distributions to employees and IRA owners and for after-death distributions. The rule before 2020 was, under the Secure Act, RMDs for qualified retirement plans and IRAs generally must begin by April 1 of the calendar year following the calendar year in which the individual reaches age 72, effective for distributions required to be made after December 31, 2019. Okay, so for distributions required to be made after December 31, 2019, the age for beginning mandatory distribution is increased to 72. You see, if you have a retirement plan and you're supposed to take out money, you cannot keep your retirement plan you cannot just keep your retirement plan and not be withdrawing from it from your account and continue accumulating interest. So that's why they have this tax provision required minimum distribution rules. Okay, so let's go for the repeal of maximum age for traditional IRA contributions. Okay, effective for tax year beginning after 2019, the age 70 and a half maximum age limitation for making deductible traditional IRA contributions no longer applies. You see, this applies to the traditional IRA. So it used to be that the prior law is prior to 2020, taxpayers who had attained age 70 and a half were prohibited from making contributions to their traditional IRA. If you reach this age, you're not allowed to contribute anymore to your traditional IRA account. Okay? Now let's go to the tax provisions um, relating to businesses. Okay, now what are the tax provisions that we have for this year? We have PPP, the PPP program, research and experimental expenditures provisions, net operating loss, and NOL carrybacks. This is very important for you guys. You definitely need to discuss this with your financial planner or your CPA or tax practitioner. Bonus depreciation for qualified improvement property, limitations on excess business losses. The Paycheck Protection Program loan. Okay, the prior law is loans that are forgiven are generally taxable income for the borrower of the loan, unless one of the special exceptions applies, such as debt forgiveness due to the taxpayer being insolvent. You see, if you were bankrupt before and you receive a 1099-C, or if you have a loan that was forgiven, then that is an exception wherein your forgiven debt is not taxable. So the the let's read this. The PPP is a small business administration loan to employers to help keep their employees on the payroll while their business is shut down due to COVID-19. The loan is forgiven if at least 60% of the proceeds are used for payroll costs and no more than 40% are used for interest on mortgage obligations, rent, or utilities during the period beginning on the loan's origination date and ending on the earlier of either 24 weeks after the loan's origination date or December 31, 2020. Any amount that would be includable in gross income by reason of debt forgiveness is excludable from gross income provided certain requirements for use of the loan proceeds are met. Amounts excluded from the gross income are considered class exempt income under IRC section 265. It's still exempt. So it's not taxable. You see, this portion, we still need additional guidelines to this, but it's still exempt. There's a few questionable guidelines that need to get clarified by IRS about this, because there's a few conflicts that needs to get verified. Any otherwise allowable deduction is disallowed to the extent such expense is allocable to tax exempt income. Effective for 2022 under the research and experimental expenditures tax provision, research and experimental expenditures are required to be capitalized and amortized over a 5-year period. Research conducted outside the U.S. require 15-year amortization. Computer software development is defined in the code as research or experimental expenditures. If the property is retired, abandoned, or disposed of with respect to which research and experimental expenditures were paid or incurred, the cost must continue to be amortized over the remaining amortization period. Okay, so the prior law is business expenses associated with the development or creation of an asset having a useful life extending beyond the current year are generally capitalized and depreciated over the useful life of the asset. An election is available to deduct currently the amount of research or experimentation expenditures paid in connection with a trade or business. Taxpayers can choose to forego a current deduction, capitalize the cost, and amortize them over a period of not less than 60 months, 5 years. Costs incurred in the development of computer software has been ruled to be research expenditures. Okay, so let's go to the net operating losses. For a null net operating loss occurring in any tax year beginning after December 31, 2017 and before January 1, 2021, a null must be carried back for each of the 5 tax years preceding the tax year of the null. The taxpayers can make an irrevocable election to relinquish the carryback period for a null for any tax year and thus only carry the null forward. You see this irrevocable? If you selected to carry it forward, you cannot change it. Okay? If in 2018 you selected to carry it forward, you cannot go back. Okay? The a null deduction of the tax year equals the aggregate of the null carryovers and carrybacks to the tax year. Used to be there was an 80% limit. So prior to the Tax Act and Jobs Act, the TCJA, in general, a null could be carried back 2 years, and carried forward up to 20 years. Effective for nulls occurring after December 31, 2017, TCJA repealed the 2-year carryback, so you cannot carry back anymore. With, of course, there are exceptions for the farming and casualty insurance companies. No carryovers were limited to 80% of taxable income for the year in which it was carried to, and could be carried forward indefinitely until used up. You see, so before 2017 you can carry back 2 years, and then you can only carry forward up to 20 years, and then 2018 after 2018 you can only carry forward 2 years, and you can carry back 2 years with the exception of like the farming industry and the insurance companies. So but for this year you can carry back 5 years. Okay, you can carry back 5 years beginning 2018, 19 and 20, right? So you can carry back your losses from 2018 to 2013. Okay, you can you can carry back to each of the 5 tax years preceding the tax year of the null. So if your tax loss is in 2018, so minus 5, it's 2013. Okay, so you can go back up to 2013. But if you're going to do this and you're going to try to amend your tax returns, you got to double check as well, because in 2018, 19 and 20, the maximum tax rates for corporations are 20% compared to 35 or 37% from the previous years. And for 2021, I believe it's going to go back up to 37%. Yeah, so the tax rates are going to go back up. So you gotta double check and review your financial planning with your tax practitioners. Okay. Bonus depreciation for qualified improvement property. Qualified improvement property placed in service by the taxpayer after December 31, 2017 is 15-year property and thus is eligible for bonus depreciation. The tax law changes is retroactive as if it was included in the TCJA. The TCJA, they actually, this was a big factor because it was a big mistake by the Congress way back when they implemented the new TCJA 2017 rules. Prior to the TCJA, qualified improvement property was classified as a specified type of property. So there's actually different specifications for each of the properties eligible for bonus depreciation. So although Congress intended to treat qualified improvements property as eligible for bonus depreciation, the TCJA eliminated qualified improvements property placed in service after December 31, 2017 as a specified category of qualified property and amended IRC section 168 to eliminate the 15-year property classification for qualified leasehold improvement. Limitation excess business losses. The limitation and excess business losses of a taxpayer other than a C corporation does not apply for tax years beginning 2018, 19, or 20. Okay. Um, the CGJA, the Tax Cuts and Jobs Act, introduced a new limitation on deducting business losses for tax years beginning after December 31, 2017 and before January 1, 2026. This limitation applies to all excess business losses of a taxpayer other than a C corporation. Excess business losses are not allowed for the tax year of loss. So if you have an excess loss, you have to carry it forward. Instead, they are carried forward and treated as part of the taxpayer's net operating loss for, subject to the null rules and carryover limitation. An excess business loss is equal to the aggregate deductions attributable to the trades or businesses of the taxpayer for the tax year, determined without regard to whether or not such deductions are disallowed under the limitations over, and the second one is the sum of aggregate income or gain attributable to such trades or businesses of the taxpayer for the tax year, plus the threshold amount of $250,000 for a single filer or $500,000 for a married filing joint. Additional tax provisions that we have to discuss that's are very important: business interest expense deductions, delay of payments of employer payroll taxes. This one, if you can pay it now, I suggest that you pay it. Tax credits for paid sick and family leave, employee retention credit, and prior year minimum tax liability of corporations. So let's go to business interest expense deductions. Effective for tax years beginning in 2019 and 2020 only, the 30% ATI adjusted taxable income limitation is increased to 50% of ATI. Okay, effective starting in 2018, from the prior law, the Tax Cuts and Jobs Act amended the business interest expense deduction rules for taxpayers with average annual gross receipts in excess of 25 million. The deduction is limited to the sum of business interest income for the tax year and the 30% of the adjustable taxable income of the taxpayer for the tax year, but not below zero, and the floor plan financing interest of the taxpayer for the tax year. So this is the bigger deal on this one. So instead of the limitation was only up to 30% of the adjustable taxable income, it was increased to 50% adjustable taxable income. Okay, so now let's go to delay of payment employer payroll taxes. For the period beginning March 27, 2020 and ending before January 1, 2021, 50% of the applicable employment tax is required to be deposited, may be deferred until December 31, 2021. The remaining 50% of the applicable employment tax is required to be deposited may be deferred until December 31, 2022. Self-employed individuals may defer payment of 50% of their Social Security portion. The Social Security portion, that's the 6.2%. Okay. Of the SE tax liability until December 31, 2021, with the remaining 50% deferred until December 31, 2022. Deferral also applies for employment taxes reported on Schedule H. This is if you have, employees, like babysitters, nannies, gardeners, let me see. The prior law is on this aspect. Employers withhold Social Security taxes from employee wages and generally deposit these taxes along with the employee's portion of the Social Security taxes on a quarterly, monthly, or semi weekly schedule. Self employed individuals generally pay SE taxes through quarterly estimated tax payments. The thing is, if you don't do your deposits before, um, as you were scheduled to do, then you're going to get penalty, late payment penalty, or if you file late, you're also going to have a late filing penalty. But for the period of March 27, 2020 to January 1, 2021, you can actually defer your tax liability compliance requirements up to December 31, 2022. Tax credits for paid sick and family leave. Okay, so for the pay period beginning April 1st, 2020 and ending December 31, 2020, employers with fewer than 500 employees are required to provide employees with up to 2 weeks of paid sick leave and up to 10 weeks of paid family leave. Paid sick leave and family leave must be for reasons when an employee is unable to work due to COVID-19. Paid family leave must be to care for a child whose school is closed due to COVID-19. Let me see. The prior law is on the FMLA, the Family and Medical Leave Act, generally entitles eligible employees of covered employers to unpaid job protected leave. If you take the FMLA, you will have unpaid job protected leave for specified family and medical reasons. There's no provisions under federal law to require employers to provide employees with paid family and medical leave. The law merely protects the employee's job for the time period of the employee is unable to work due to family and medical reason. You see, before when you apply FMLA, your work is protected, okay, and it was unpaid. But for 2020, your work is protected and you are paid for the time that you are on the FMLA leave, on the paid sick leave, 2 weeks and up to 10 weeks of paid family leave. See, that's the difference. And then and the employer is entitled to reimbursement from the federal government equal to 100% of what they paid, of the required paid leave that is paid to employees. Whatever they paid for the 2 weeks and up to 10 weeks of the family leave, the employer can get a reimbursement of that from the government. The reimbursement is made in the form of a refundable tax rebate, credit against the employer's payroll tax liability. A similar credit is also available for self-employed individuals. Now let's go to employee retention credit. For qualified wages paid after March 12, 2020 and before January 1, 2021, employers are allowed a refundable tax credit equal to 50% of qualified wages, including applicable qualified health plan expenses. The credit is designed to encourage employers to retain their workers when their business operations slow down or are suspended due to COVID-19. You see, the employee retention credit from the prior law has been used over the years in response to natural disasters, such as the California wildfires that we had, on a yearly basis that we have here, or hurricanes Katrina, Rita, Wilma, Harvey, Irma, and Maria. The previous hurricanes, the really bad disasters that we had. The credit is designed to encourage employers affected by such disasters to retain their employees even though business operations slow down or are temporarily suspended due to the disaster. Now let's go to premium year minimum tax liability of corporations. The new law accelerates the full recovery of the minimum tax credit from 2021 to 2019. Thus, the minimum tax credit is allowed and refundable for tax years beginning after 2017 in an amount equal to 50%, with any remaining minimum tax credit carry forward allowed in full for tax years beginning in 2019. The previous law, with the TCJA, the Tax Cuts and Jobs Act repealed the corporate alternative minimum tax. There's no more AMT for tax years beginning after December 31st, 2017. Okay? For tax years prior to the AMT repeal, corporations were allowed a minimum tax credit in the subsequent tax years to the extent that the corporation's regular tax liability exceeded its tentative minimum tax in the subsequent year. For tax years beginning after December 31, 2017, the minimum tax credit may offset a corporation's entire regular tax liability for the tax year. In addition, the minimum tax credit is allowable and refundable for a tax year beginning after 2017 in an amount equal to 50% of the excess of the minimum tax credit for the tax year over the amount of the credit allowable for the tax year against regular tax liability. For tax years beginning in 2021, any remaining minimum tax credit that has been carried forward is allowed in full. And that is our tax provision update mini webisode for individual and business tax provisions for 2020. So, happy holidays, everyone. If you have additional information, please do not hesitate to call me or contact me. Again, my name is Lily Chilton. I am an enrolled agent, a certified acceptance agent, and an electronic returns originator. And my email address is lily@cpa-consultants.com. My telephone number is 310-800-1932.